Good morning, everyone. Thank you for joining us today for this informative and insightful webinar. I think it's quite topical, and we're glad that you could join us. My name is Jeff Feinstein. I'm the managing partner and co-founder of Pinnacle Partners. We are exclusively investing in opportunity zone real estate projects. And we'll talk about what I call the pair trade between monetizing stock sales and investing in alternative assets. If you've been following the market of late, you've probably been aware of the tremendous gains, particularly in the NASDAQ. I think on the year, we're up 30%. Notable names like NVIDIA, up 167%, depending upon the day. Amazon up 64%, even Oracle approaching all-time highs. And so if you've been able to enjoy this run-up in the market of late and have low basis or concentration, you are an employee of one of the aforementioned firms or an investor in these notable names, we're going to be discussing strategies to mitigate risk, monetize those gains most tax efficiently through the application of hedging, collaring, option strategies. And to do that, I'm really pleased to have John Porter, the CEO of 3Bell Capital, joining us today as our guest. John is the CEO of the firm. The firm has a distinct clientele, which is predominantly technology executives. This is an ongoing part of their conversation. And so we're really, really pleased to have John join us and talk about some of these strategies for those that have enjoyed significant appreciation, say, in the past year. So, John, thank you for joining us. Why don't you tell us a little bit about yourself and 3Bell?
Yeah, great. Thanks a lot for having me, Jeff. And thanks everybody for logging in. We try and keep it really informative and actionable so you walk away with some bullets to fire here. So 3Bell is a registered investment advisor with the SEC. So we're an independent firm. We were founded coming out of the financial crisis in roughly 2010. And that was one of the reasons why we had such a strong focus on alternatives sort of from the beginning. We have about 300 families that we work with. As Jeff alluded to, most of them are dealing with concentrated positions in some way, shape, or form, either as executives at technology companies or founders at some of those companies. And we're excited to be here, excited to share, the conversations that we have on almost a daily basis with our clients. Which center around how do you effectively manage a concentrated position? What are the arrows that you have in your quiver? What are some of the pros and cons? And like I said, hopefully we'll leave you guys here with some actionable ideas with opportunity zones and some of the things that we're personally doing with Jeff's firm as one of them.
Thank you very much, John. So a little personal anecdote. I myself am a recovering tech exec. So I entered the technology market in 1986, the same year Microsoft went public, if you could believe that. And I had a long 30-year career at a variety of companies. And I probably experienced, I'd say, 4 hype cycles. So I'm going to date myself, but originally in 86, I was not at Microsoft, but I was at a large mainframe manufacturer called Unisys. And so I wasn't on the PC computing trend, but I was on distributed systems and then online transaction processing systems, and then the advent of very large databases like Oracle. Fast forward a little bit further, the telecom boom, when the advent of wireless, and stocks like Lucent and Nortel were rocketing like NVIDIA is today. Then you move closer towards the advent of the internet, and Cisco, of course, was the flagship stock. And as we know, there's volatility in the market. Now, as I was an executive at a publicly traded company, and then later with a privately held company that we actually sold to IBM, I was always dealing with the issue of concentrated, well, my time, right? And my wealth was concentrated in the company that employed me. And I was systematically allocating to real estate along the way. That's how I got into real estate during the Great Recession. Different story. My point is, and I think I understand the perspective of most of our audience, I was always trying to juice a little bit more alpha from that stock that I held. And I had enjoyed some significant gains. It might be at all-time highs, thinking it goes higher. But of course, we know, not everything goes to the moon, and things adjust over time, and cycles ebb and flow. And we're experiencing that. Obviously today, Apple's getting knocked 3%, NASDAQ down for the fourth day, and these are exogenous conditions, right? China puts a ban on iPhones and so forth. NASDAQ comes crashing down. So I've been in this position. And I wish I had an advisor that could have given me a roadmap. So that's what we're going to talk about today. And so, if you want to apply a little macro now or not, your choice. But with your clients today, given the run up in the NASDAQ, one, are you having these active conversations about monetizing some gains? And then more specifically, what are the strategies you're recommending to your clients?
Yeah, I think the macro overlay is probably a pretty logical place to start. But if I would go back even into 2022, where we really saw the tech reset, and so coming into and coming out of COVID, the market in general dropped, but then recovered. It was such a dramatic V shape and in such a short time frame that it didn't really necessarily change people's thinking or their strategies as it related to concentrated positions. But the collapse, in 2022, led by, tech kind of resetting off of those ultra high valuations, that 100% introduces concept of vulnerability, into, in particular, concentrated tech positions. So clients, after that period of time became very keenly aware that, the technology stocks don't necessarily always go up and to the right, and they don't always recover necessarily as quickly as the larger market did in 2020. And you're seeing it obviously, come back this year, but it's in some cases you still have like stocks that have been, fairly well decimated. You come up 30%, but you went down 60, you're still down pretty far. And so the whole point of that is simply that no one really thinks about diversification and risk management when stocks are always going up and to the right, or have been for a decade plus with very small hiccups. 2022, I think, really changed that perspective, and clients started understanding and wanting to learn more about how they could diversify out of that position. So I think the macro is definitely, it's a backdrop to everything. So when we talk about strategies, there are not that many strategies, for diversification, and the different ones have, either positive or negative, tax impact. And so if you think about, what's available to you, we'll start with the easiest one, and that is you sell a portion of your stock, right? If you're going to do that, you sell it, you're going to diversify it, then you're going to try and sell it, long-term capital gains. And that's about as favorable as tax treatment gets, in that respect, right? So the second strategy is and this was something that we employed quite a bit until interest rates went really high, and that is you could always apply a margin, to a publicly traded position. And for a very long time, we had margin rates that were sub 2%. So you could hang on to your stock, borrow against it with margin. The margin interest was tax deductible, so that was generally a net positive. And then you could take the capital that you extracted from that concentrated position and diversify it into other things, buy other things with it. That trade's largely gone now, because the hurdle rate associated with the interest rates on margin now is over 7%. So now you better be damn sure that whatever you're buying with your margin is making more than 8. It's not the same trade. And so I wouldn't even consider that an option right now, but it might be at some point in time in the future when interest rates go back down. The third option is an exchange fund. And exchange funds are where you take a concentrated position and you essentially buy into the exchange fund with your concentrated position, and they give you back exposure to a broad basket of securities. And the challenge with exchange funds has always been twofold. One, most of the time when you're an employee or an executive at a company, you have a higher degree of confidence in your own company than the basket of securities that you're getting back. And a lot of the times that's because the basket of securities that you were getting back wasn't concentrated into the tech sector. It was a much, broader Russell 2000, kind of exposure that didn't necessarily have the same growth potential. So you really were sacrificing gains for the sake of diversification. And there were only a few vehicles that were available in the exchange traded fund world. And those vehicles had to need or have room for the stock that you were contributing as the technology executive in order for them to even ingest it and for it to be an option. And it turns out that confounded exchange fund trading pretty effectively for a lot of people. So is it there? Yes. Does it diversify? Yes. No tax implications of that diversification, which is one of the attractive parts of it. But there were just other, I think, challenges that made it less attractive for most executives. And then you get to opportunity zones, right? And it's opportunity zones probably one of the most powerful pieces of legislation that we've seen, at least in the last 10, 20 years since maybe qualified small business stock exemptions.
Mm-hmm.
And it was super interesting that the original legislation was first promulgated by the Obama administration and was ultimately passed in the Tax Cuts and Jobs Act by the Trump administration. And so it's one of the few, shining sort of bipartisan pieces of legislation that's actually worked and everybody agrees is a good thing. And that's hyper relevant for the legislation that's coming down the pike and the extension of some of the tax benefits, which we'll obviously get into. But the way that opportunity zones work at a high level is you sell your stock, you create a gain, and you can take all or a portion of that gain and put it into an opportunity zone project. And in so doing, you have tax-free growth of the opportunity zone investment itself if you leave the funds in for 10 years. And again, throughout the last 7 years, there were various tax breaks, which was a delay in paying the original capital gains bill that otherwise would have been due. So opportunity zones presented a really unique opportunity to diversify out, delay the taxes that you would otherwise pay. And instead of giving that money to the government, you actually put it into an investment that inures to your benefit in a tax-free manner.
Mm-hmm.
So I don't want to steal all your thunder there, Jeff. But when you look at the various forms of diversification and which one has the best tax implications, I think opportunity zones are kind of at the top of the list there.
We certainly appreciate that, and we've been working with 3Bill and facilitating this pair trade where gains are established and then allocated into our fund, which is actionable and immediate. And again, happy to discuss that with anyone following the webinar. We count many tech execs as our investors. That run up you talked about, that V-shaped recovery that had DocuSign, at all-time highs, and obviously Amazon, and I think 2000 pre-split, et cetera. People were taking. I'd have many conversations. People would sell along the way. Right. So harvesting those gains along the way. And then again, the point of view was, well, things are going to continue to run. They'll never adjust. And, I just want to sit on my hands and wait for the stock to continue to reach new highs. That's kind of those are the two talk tracks being applied. And that pair trade, once again, is probably, to just emphasize your point, the most tax efficient allocation. A couple of things on real estate as it relates to a well-diversified portfolio. The tax benefits that you describe, and I won't describe them again, but hugely compelling. And remember that when you establish basis in real estate, you get to use depreciation. So I don't depreciate my Tesla stock, right? Mm-hmm. And I don't get to, even though I may get dividends in a stock, I don't get to offset it with depreciation. That's one of the benefits of real estate. The other is, again, this is absent OZ benefits, the ability to refinance, take those proceeds tax-free and put them in your pocket. So that's what makes real estate so attractive, and why I began allocating systematically, because of that concentration of my time and money, as I mentioned in the opening. So you're talking about what to do with the gain. Why don't we also talk about the selling strategies? So are you doing options? You doing some hedging or collaring? Maybe talk a little
Yeah,
about those.
yeah. So it's kind of interesting. The options market is and with individual stocks and in general can be more or less attractive at any given time. And one of the things that we've been doing with our clients, which can be a diversification tool, but it can also just be a monetization tool, is taking these concentrated positions and writing covered calls on them.
Mhm.
And one of the things that we've been doing, which is really interesting, is most of the technology executives that we work with would prefer to keep their stock if they can and collect the premium from the covered call,
Mhm.
and ideally have that option expire worthless. That's kind of the best of both worlds,
May
right?
I
It
ask
doesn't.
that
Yeah,
premium paid, is that considered income? That is, right?
ordinary income.
There
Yeah,
you
so you get taxed on that as ordinary income. But there is a way, and we call it rolling contracts, but there's a way to basically take a portion of your concentrated position, write covered calls on it, immediately ingest that premium, reinvest it however you want. And if you get to the point where it looks like that call option is actually going to get executed, you can actually just undo that trade and roll it forward into future contracts. And it's actually shocking how few advisors actually understand how to do that. But what you can do are if you are adept at it, is you can continue to roll those contracts forward in perpetuity until you get to the point where the stock drops at the option expiry and
Mhm.
expires worthless. So it takes very active management on the part of an advisor, which is probably the reason why most advisors don't do it. But that is a really effective way of monetizing your position. If you are comfortable with and you want to diversify out of the position and you want to write covered calls, and the price target is exceeded in the time frame that the option actually is set to expire or be triggered, then you can just let the option expire. You will have collected the premium. You will have collected the gain on the stock, and you'll exit the position for whatever portion of the options is actually exercised. It's not the end of the world.
Right. It's at the price that the option was struck.
Correct.
So
Mm-hmm.
I have $100 stock. I buy the option at 120, 45
Mm-hmm.
days in the future. We
Yep.
top tick 120. I'm out. I enjoyed a $20 spread. Plus
That's
the
right.
premium paid. Plus the premium
Yeah,
paid.
that's right. Yeah, and that you can, and that's actually a really important part right now because we are seeing call premiums higher than we've ever seen.
Mhm.
So when we were in a situation where we had ultra low interest rates and very muted volatility, there just wasn't a lot of juice in the options market. So if you were selling those covered calls, maybe a quarter or a few quarters out, you might be getting 5%, right? Or 3%. Now we're starting to see on Google, Apple, Amazon, Nvidia, we're starting to see call premiums upwards of the 9-10% range. And that's a material number, especially for a concentrated position, because you get all of that call premium upfront the day you sell those options.
Mhm.
So that's pretty attractive. And like I said, if you understand how to manage these rolling contracts, you can continue to kind of roll that forward in perpetuity and prevent the diversification out of the concentrated position if you want to, right?
Mhm.
I think it's also healthy for diversification purposes to have conversations with clients and said, okay, Apple's at 160. If Apple got to 200, would you be comfortable selling it within 6 months? And it's interesting. It goes back to the example that you gave, Jeff, which is you always try to squeeze a little bit more alpha out. But if
Yeah.
you have that conversation before you get to the alpha point,
It's
right?
fun how everyone says, yeah, sign me up. I'm in.
Right, exactly. And people, and it's much more likely that someone's going to say, yeah, if I could sell this at 20% more than it is today within 6 months, I would do that. Well, you can execute the contracts, put that strategy in place, and it sort of forces you to take some of the action that you say you would take, to diversify once you got to that point in the future.
What are you suggesting? So I have a concentrated position. I want to achieve diversification goals. I do want to take some chips off table.
Mhm.
You say, okay, let's sell on the way up, preferably. I'm going to sell 10% of my holding, 5%. I mean, I know that's a specific individual conversation amongst all their
Mhm.
other assets and so forth. But I mean, rule of thumb,
Yeah,
because I'm the lucent holder holding the bag when it goes
right.
from 120 to 2. Not necessarily, but nonetheless, I don't want that. So what do you, on average, kind of ballpark, what are you suggesting in terms of clipping sales along the way up?
So I can tell you that how it typically the conversation unfolds and the execution unfolds with our clients. Almost everyone is somewhat familiar with covered call writing.
Mhm.
What they are less familiar with is how you roll contracts on a go forward basis and create an options ladder. Once they understand that, what usually happens is they start with what is at first a comparatively smaller portion of their position,
Mhm.
just so they can understand it and see it actually work.
Mhm.
And so for our clients, that was it could be between 10 and 20%,
Mhm.
of their position seems to be about the norm. It's really an individual conversation with each client, but most are comfortable dipping their toes in. And then what we found was as we went through a few of these cycles where we rolled the contracts forward and they enjoyed seeing in some cases millions of dollars of call premium show up in their account, like, well, that's pretty cool. um, they have increased it from 10 to 20 to 30. And now most of our clients, including Apple clients, who I've never met anybody that wants to hang on to a stock more than that for good reason, right?
Mhm.
They're on average, they're around 50% of their position is now, being covered by this call writing strategy. So it tends to start small and then it escalates once people get comfortable with it.
Mhm. And what about around selling strategy? What about hedging or callers? Are you
Mhm.
advising on that in addition to
Yeah, I mean,
call option?
yeah, it's so you can always buy a put,
Mhm.
a put option. So you know, if you're looking to limit your downside, you can always buy a put. If you want to use call premium to pay for that put option, so we would call it a zero cost collar. You can create a trading range, right?
Mhm.
Where if it goes up, you're going to, top out of it the same way as if you had a covered call, but you've also taken some of that call premium and you've bought yourself some downside protection. Um, I can tell you that even though from a diversification and a hedging standpoint, that is a highly intelligent strategy, most of our clients have a high degree of confidence in the companies that they're working at, and they're more interested in augmenting upside, and then if it gets called away, using that as the diversification tool. I just see that more often than the zero premium callers.
Mhm. Mhm.
Mhm.
Excellent. Yeah. Okay. Well, that's a fulsome conversation on the selling strategies, return to the allocation of the gains into
Mhm.
to accomplish a well-diversified portfolio. Our two firms have partnered to allocate into opportunity zones, which, by the way, are custody by Schwab, which is your custody partner of choice. And
Yep.
that pair trade, as I call it, is quite effective. Just a quick note on opportunity zones: short and long-term gains qualify. Once the trade is transacted, the timestamp is there. You have 180 days to allocate into an opportunity zone to mitigate your taxes and begin to earn the tax benefits that we spoke about. We didn't speak about specifically. It's deferral, it's elimination, it's use of depreciation without recapture. Again, we can go into
Mhm.
a longer conversation about that. And by the way, any realized gain, the sale of art, the sale of real estate, the sale of a business, all qualify. Anything the IRS deems a realized capital gain qualify for opportunity zone benefits. So I wanted to get your point of view on real estate as that
Mhm.
alternative asset. So I've got this concentrated position. taken some chips off the table, and now you're recommending I invest in real estate, and I'm concerned about maybe office, or I don't know much about multifamily. I'm curious what that conversation is amongst your clients.
Yeah, yeah. So, I mean, if you just take real estate itself as an investment, as an asset class, it's historically generated phenomenal returns. There are periods of time where it's been in a down cycle, but historically speaking, over a long period of time, as my dad always said, they're not making any more dirt, and we keep putting more people on the planet. So, eventually that trade works in your favor. Yeah. So if you think about the cyclicality of real estate, right? We are undoubtedly going through kind of a tough go right now, right? You had, the Great Migration, where you had so many people, move either during or immediately sort of post COVID. And as that migration occurred, you had, in some cases, the net recipients in those areas. You started to see, housing really appreciate because of increased demand, where in those geographic areas where people were moving and are now continuing to move, right? There are several other areas of the country that are suffering fairly greatly because high interest rates usually means less demand for real estate because people can afford less, right? If you look at what your mortgage looks like with an 8%, 30-year fixed versus a 3% 30-year fixed, you can afford a lot less house. And so there are portions of the country where I would probably not recommend investing in real estate right now. There are also equally portions of the country that I think were net recipients of the Great Migration, net beneficiaries, and I think that the ship has left the gate, right? And I think that those areas are going to continue to experience that kind of growth. And for those areas, and for the types of housing there, I think real estate's a phenomenal investment. And if you can do it inside of an opportunity zone, then you can do so in a way that creates some really great tax benefits as you diversify out of a concentrated position. Relative to the types of housing, you want to be investing in what's in the highest demand. And I know that probably sounds like, well, yeah, duh, right? But unless you're going into sort of distressed, class A office space, and that's kind of the angle that you're taking, I'm probably going to stick with real estate investments that are mixed use, that have a heavy emphasis on residential, because that's where the demand is. Again, commensurate with this Great Migration. If you can then double click on that and get into housing, that would be considered, say, workforce housing, where there is such a huge supply demand imbalance for just affordable housing. It doesn't have to be subsidized housing, but just affordable housing in these areas. The supply demand imbalance is so high that the risk reward trade-off ends up being, just that much more attractive, because your occupancy is almost certainly going to be at near maximum capacity as soon as they're made available. Yep. And that at the crux of what opportunity zones are doing is that they are they're developing real estate, and they're doing it in areas that are going through economic gentrification. So, you get the advantage of the taxes, but you also get the advantage of investing in an asset class that's helping people to, find homes and to live and work in sort of this new normal.
That's right. And, so we focus on multifamily exclusively in the markets that have benefited from the Great Migration, as you described, have very strong secular economic trends. What we like about multifamily, it's a hedge against inflation, because you can mark the market each and every year with your rents rise. Now, I know, not to digress us into inflation and CPI, shelter being a large component of CPI, we're expecting that shelter number to come down relatively significantly. Let's hope to get inflation under control. But nonetheless, you can see the correlation between inflation and rental rates. And again, we have created, and you have invested in through your clients, our diversified fund of 4 OZ, just 4 high quality OZ projects in in Denver, in Nashville, in Phoenix. And then we've got this build to rent concept. Well, we didn't invent it. It's just that we're investing in the product category, which is a bit of an arbitrage between that, that very high rate of interest for mortgage and, first time home buying out of reach for many, yet they want to live in a single family home. They desire proximity to schools and services. So they can now rent that in a build to rent community. It's a relatively new topic, but that's 2 of our 4 projects represent that product category. I'm going to
so Jeff, you touched on one thing that I think actually, bears just an extra mention / emphasis, which is that, if you're looking at opportunity zones and you're looking at the various funds that have been created in order to address those opportunities and take advantage of the tax benefits, most of the opportunity zone funds are single projects. And so one of the things that, I'll just tell you that we love about Pinnacle is that it offers diversification, not just into real estate, but across different geographic areas, across multiple projects. So when we think about, we have our asset allocation hat on and we think about mitigating risk, you are mitigating your risk if you can spread your investment out across multiple different projects in multiple different areas. And so that's, from a diversification and a risk management standpoint, it's hands down the way to go versus going into, a one-shot deal where you're taking some concentrated project risk.
Yep. I appreciate that, Haptip. Thank you.
Yep.
I'm going to ask the audience to load any questions in the Q&A chat. I see one here now. So if anyone has questions for John or for myself, please go to that Q&A button. So this has been fantastic, John. I think we covered a lot of ground. I'd like to get, because I always like to ask, everyone's got a point of view, of course, and nobody has the crystal ball, but would love your sort of macro view looking forward. You can go any direction. You can talk about the market. You can talk about rates, recession, impending recession, whatever the case may be. Love to hear your point of view as we look out for the balance of the year.
Sure. Well, let me touch on that. And then as we sort of look forward, I can answer the question that just came in from Khan about, what are we seeing in terms of the OZ legislation, coming down the pike, and whether or not we think that's going to extend that tax holiday, right? Because that actually was a really interesting and powerful part of the original legislation.
Right.
So starting, way high up, and again, with the compliance crystal ball, I don't have one, disclaimer. If you look at just the beginning of 2023, right, every economist on the planet predicted that we were going to go into a recession. And it was really a question of, is it going to be a medium recession or is it going to be, something deeper and more sinister? And you fast forward to where we are now, roughly maybe 3/4 of the way through the year, and that's completely flip-flopped. Now there are only a few economists that are saying, we may go into recession. And if we do, it's probably going to be fairly shallow. I can tell you that I tend to rely on common sense quite a bit when I try and formulate my opinions about the market, because the economists are almost always wrong. I think that if you look at where we are, we have an ultra high interest rate environment. We have rates that are higher than they've ever been. We have a Fed that's signaling a pause for right now, but probably 2 more 25 basis point, rate hikes coming forward. There's plenty of data out there if you dig deep enough to say that inflation is actually not coming down. It might have leveled off, but it's not really coming back down the way that maybe they had hoped. And I think that in that environment, you have commercial real estate, which is like office space in particular, which is going to come under, I think, quite a bit of, like, your traditional office space is going to come under quite a bit of stress, because you have so many people that are, working from home or have a flexible kind of hybrid environment. The world is rethinking what the traditional office looks like. And that's going to cause a lot of pressure in the commercial real estate market. And everywhere but these sort of, again, geographic net beneficiaries of the Great Migration are experiencing a housing crisis, right? They're experiencing a pretty dramatic drop in residential home prices. You couple that with, an economy that is doing a little bit better than we would have expected, but still by no means, ripping along. And I think we're still very much in danger of a recession. I think we're one domino flick away from things getting pretty bad pretty quickly. And that's coming from, someone who is generally fairly optimistic, about the markets and about the economy and at least the United States' ability to navigate that. So I don't think in any way, shape, or form, a recovery, let's say in the NASDAQ, is a translation to we are out of the woods, from a macroeconomic perspective. And so, bringing that back around, I think diversification is still probably something that needs to be part of the conversation, between any of the folks that are on this call and your wealth management team, right? Mm-hmm. How do you do it intelligently? What are the arrows in the quiver? Many of which we talked about today, but I think there's, I think there's a rocky road. I think there's a turbulent waters ahead. You always look back and you go, of course there was a recession. All of these things were going on, all these common sense things, but you never really know what's going to trigger it until it's triggered. So I think that's my, yeah, exactly. I think that's my sort of, macro view of things. If you look at some of the things that impact us and reduce our spending, right? You've got an economy that's based almost entirely on consumer spending, right? 2/3 consumer spending. We don't have a whole hell of a lot to spend when we're spending $6 a gallon for gas. Or when our energy prices are through the roof, food prices are through the roof. Inflation, hits at home in some very real ways, and they reduce people's, cash flow, and they reduce what they can spend out into the economy. And you don't have to be an economist to understand that that's going to slow things down. So I think, energy is going to be a huge one. Foodstuffs is huge. And as you noted, the cost of housing is going, up now. Rents in, say, New York, which was devastated, by COVID, right, they're higher than they were pre-COVID.
That's right. Rents.
So, yeah. So I think, there's a lot of reason to be cautious, right? And again, it goes back to the necessity of really having an intelligent conversation about diversification and monetization of a large concentrated position. I'll just mention really quickly, and then I'll turn to some of these questions. But we started working with a new exchange fund. It's brand new to the market. It's going to launch here in the next month. And we were talking to the founder. They had a really cool chart, which I can send out to anybody here that's interested. And it talked about the 10 largest companies, the 10 largest tech companies in 2000 versus the 10 largest tech companies today. And it was really fascinating because Apple was non-existent, right? Well, and now Apple's this,
I was trying to refer to that in my opening, right? Because Lucent, remember Nortel? They're gone.
Exactly. Right. I mean, it's really fascinating. And, Microsoft was a huge portion that went down, and it's, come back again. NVIDIA has, obviously just gone boom, and now it's this huge position. But what it shows you in a pretty powerful, visual way is that no one stays on top forever. Right. And you never quite know when things are going to roll over, and Cisco is a great example of that, right? So anyways, I can send that chart out for anybody that's interested in it.
But let's do that as a follow-up and to include this recording. I'm looking at the questions. There are two questions around OZ legislation. So remember, there are 3 benefits to OZ investing in addition to the investment in a high-quality real estate project. So you qualify for deferral of the tax on the sale of the stock for a period of time that is due April 15th of 27. You enjoy the use of depreciation without recapture throughout the holding period. And then at the time of terminal sale, assuming a 10-year hold, you qualify for tax exemption. You pay zero capital gains tax. If your $1 million becomes worth $4 million, the $3 million in appreciation is tax-free. There's no other vehicle that allows for tax exemption.
I'll
So
also point out there real quick, Jeff, that most people think about the OZ, the tax-free, gains in the opportunity zones as the gains that are achieved over a 10-year period, because that is the minimum hold. But what's interesting is there's no maximum hold period. So if you're in an opportunity zone, project that continues to appreciate nicely in year 11, 12, 15, 20, you can leave it in there as long as you want. It functionally becomes a Roth like structure. And so that's extremely powerful, right?
Yeah.
So I think that bears mentioning. And in terms of depreciation recapture, the best way to think about that is it creates, I won't say tax-free income from the opportunity zone project, but if they kick off income, you are able to offset a pretty sizable portion of that income, which would ordinarily be taxed as ordinary income, with that depreciation. And the big difference, and this is specific to opportunity zone legislation, is you don't have what's called depreciation recapture when you ultimately sell the building or refinance the building. And that is huge, right?
Oh, yeah.
In every other building or anything really, if you're doing depreciation recapture, you have to add that back into the cost basis when you ultimately sell it. So you end up paying more taxes on the sale, even as you reduce taxes on the income. So that is a massive benefit to opportunity zones, and something that I think gets overlooked a lot. Opportunity zones can be a very powerful fixed income vehicle, right? It's a collateralized fixed income vehicle with a tax advantaged income stream in certain cases where that exists at the project level.
That's right. Yeah. Well, thank you for that discussion on depreciation without recapture. And so the question that was posed is about the extensions we alluded to. There is bipartisan legislation proposed by Senator Tim Scott and Cory Booker, R&D, to extend these benefits, to move the deferral out to 2029, to reinstall a step-up in basis on the deferred tax, putting some reporting requirements on us. So watch this space. We have debt ceiling, we've got other things as we move to end of year, but it's possible, we rate it 50-50, that the program gets expanded and extended. I'm looking at the questions here. And somebody asked about, and I'm a resident of Washington State, and we have, unfortunately, a new Washington State capital gains tax. So the stock sale that, this webinar is all about is not, you can't defer from the state tax. This is a federal program only. I will say real estate sales in the state of Washington are exempt from the Washington State capital gains tax, if you can believe it. So when we sell any one of these projects from our fund and you're a Washington State resident, you'd be exempt from the state capital gains tax.
Steve asked a question about just being grandfathered in, right? So some of you may find yourselves in a position where you're going to trigger a gain. You're going to sell some stock. Maybe you need to because you need to fund something else, and you're just trying to figure out, how to mitigate those taxes. If you want to take advantage of opportunity zones, you do have a time frame after you trigger the gain in which you have to put that cash that's triggered from the gain into the opportunity zone. And so a lot of our clients are looking at the tax holiday, which was really attractive in 2017 because it went to 2026, right, or basically 2027, the beginning of 2027. And now they're like, it's a little bit shorter now because we're just that much closer, right? So they're really trying to benchmark what are the chances that 2026 timeframe gets extended out another 9 or 10 years. And Jeff, you spoke to that, 50-50. I would say that at least from, what our lobbyists that we pay attention to in Washington are seeing, there's wide bipartisan support for the extension. It's very widely viewed as a very successful program. It did what it was intended to do, which was funnel dollars into these areas and gentrify them and create more housing. So I would put it at a high probability. And I would also say that if you're in a position where you trigger a gain and you've got this 180 days where you've got to, put it into a qualified opportunity zone, at least it's 180 days, right, Jeff?
180. Yep.
Yeah, that's what I thought. Okay. I just want to make sure I wasn't giving everybody the wrong stat. But if you find yourself needing to make that decision, I think it's highly likely that if you were to put it in now and then the legislation passes, they're going to grandfather you into any extension, right?
Yeah.
So
I would agree with that. Yeah. 100. Yeah, I'd agree with that 100%. And so and we have a few of our investors, as I mentioned, we've got a lot of tech investors, tech executives as our investors, and they may have, in some cases, I'm certain they have already made investments in opportunity zones. They're going to get the benefit. They're already invested. They're going to get the benefit of the extended deferral. And if you invest today, as an example, which some people, by the way, you can look back, we think 180 days forward, but you can also look back 180 days. There's still a short window to mitigate your 22 taxes if you just got a K1 in particular from a hedge fund that generated gains unexpectedly. You can still invest those gains into an opportunity zone and mitigate 22 tax. Going forward, 23 tax. And I appreciate your bullishness on the extension. We're looking forward to it. We're talking to policy influencers all the time. So maybe one or two more questions. Let's see. In the OZ, by the way, there's again a number of requirements. So you need to substantially improve the asset. This is the economic activity John's talking about. So the gain goes in. You can't just own passively a cash flowing asset. You got to double the basis in the asset. So that has led to ground up construction, which we pursue. And you have then the opportunity to refinance the construction loan and return capital back to the investors in lump sum tax-free. So this is now the benefits of traditional real estate working in your favor and delivering some proceeds potentially to cover that deferred tax whenever that tax may be due in 27 or 29. So a commentary about that. And I think we're coming to the conclusion. John, do you have any final comments for the audience?
No, I'll just say, it's the strategies by which and the ways that you think about concentrated positions is very nuanced, and it's a very personal thing, particularly when that concentrated position comes from having worked at or currently working at the company. I spent 5 years at Apple. I was there in 2000. I left in roughly 2006. So I was there when Steve was there, and there was all kinds of crazy appreciation that occurred there. And the one thing that was the surest way to, as a financial advisor, to turn an Apple executive off as a client was if that advisor came in and said, "You should diversify out of your Apple." It would get you turned around and walked out, as quickly as you could possibly imagine, right? And so it really is a very personal, nuanced thing. And I would encourage everybody, to think about that diversification, not as selling and just paying the taxes is the solution, or an opportunity zone is the solution, or writing covered calls or hedging and monetization is a solution, or exchange funds are a solution. We didn't talk about charitable, trusts, but that's certainly one way to go as well. The reality is the conversation that you want to be having with your wealth manager should sort of span all of those. In many cases with our clients, it's a combination of those strategies, right, in concert, that end up being the right answer for that particular client.
That's right. Well, John, we're really pleased to partner with 3Bell. I will move to close here. We'll get everyone this recording. We'll get the chart you spoke of, John. Obviously, our contact details. Happy to talk about opportunity zones, funds with anyone interested. And for us, Pinnacle, we're pleased to partner with thought leaders like Three Bell. We are interested in bringing practitioners to the table on an ongoing basis, this so-called seminar series. So we're really pleased to have had this on the subject of concentrated stock positions. So thank you, John, and thank you to everyone
You got it.
in attendance. Have a great day.
Yeah, and guys, reach out if you have any questions. You guys will have my email after this. We'll answer everything that you didn't get to today, okay?
Right on. Thank you,
Thanks
John.
for having us, Jeff. Thanks, guys.
Got it.
Have a
Bye-bye.
great day.
Bye-bye.